Welcome to This Explainer. When you look into a massive global corporation, you're almost never looking at just one single entity. It's more like a corporate family tree, this sprawling, tangled network of subsidiaries, joint ventures, and off-book vehicles. And historically, these complex webs have been the absolute perfect place to hide massive financial risks. So today, we're bringing out the X-ray machine. It really comes down to the ultimate high-stakes question for anyone analyzing financial statements. What is a company actually hiding off its balance sheet? Imagine an off-balance sheet entity suddenly goes belly up. Is the parent company secretly on the hook to bail them out? Well, before 2011, finding the answer to that was literally like looking for a needle in a haystack. The risks were just completely buried.
To solve this huge problem, the International Accounting Standards Board stepped in and created a pretty powerful diagnostic tool in May of 2011. Enter IFRS 12. The core objective here is crystal clear. Force entities to disclose information that lets us, the users, evaluate the nature of and the risks associated with their interests in other entities. It completely replaced an older, really fragmented set of rules, we're talking IS 27, 28, and 31, and brought all these critical disclosures under one unified umbrella.
Okay, here is our roadmap for this explainer. First, decoding corporate family trees. Second, judgments and assumptions. Third, inside the subsidiary family. Fourth, joint arrangements and associates. And finally, uncovering structured entities. Let's get right to it.
Section 1. Decoding corporate family trees, or the scope of IFRS 12. We really need to figure out exactly who the relatives are in this corporate structure.
So IFRS 12 casts a really wide net. It applies to entities that have an interest in four main groups: subsidiaries, joint arrangements, associates, and unconsolidated structured entities. Now, there are a few very specific exceptions, like post-employment benefit plans, which actually fall under IS 19, or certain interests handled by IFRS 9 financial instruments. But honestly, for the vast majority of corporate relationships, these four buckets are your primary targets for investigation.
Moving into Section 2, Judgments and Assumptions, which is really all about forcing management to show their hand. And this is crucial, because let's face it, accounting is rarely just black and white math.
What's genuinely fascinating here is how the standard flat-out acknowledges the heavy subjectivity in corporate accounting. IFRS 12 forces companies to publicly reveal the specific assumptions they made when deciding who actually controls what. Like, do you hold less than 50% of the voting rights but still claim you run the show? You have to disclose exactly why. Hold more than half the votes but say you don't have control? You better explain it. Even deciding whether you're acting as a principal or just an agent requires disclosed assumptions. It's a total game changer because it exposes potential loopholes right there in the footnotes. This subjectivity also heavily impacts what we call investment entities. By definition, an investment entity is a parent company that measures its subsidiaries at fair value through profit or loss instead of consolidating all their financials line by line. But here's the real kicker. If a parent claims to be an investment entity, but they don't actually look like one, like they lack the typical characteristics, IFRS 12 says they must publicly disclose their reasoning. They literally can't just hide behind a label anymore.
All right, Section 3. Inside the subsidiary family. These are the direct children of the corporate parent.
When a parent fully consolidates a subsidiary, the numbers just sort of blend together into one big pot. So IFRS 12 requires specific disclosures to untangle them, helping investors see the true composition of the group. Companies have to disclose the interests held by outside, non-controlling parties, the consequences if they were to suddenly lose control of a subsidiary, and, this is a big one, any significant restrictions. Are there legal or contractual barriers stopping the parent from moving cash around or settling liabilities across the group? You absolutely need to know if the parent's cash is trapped down in a subsidiary.
Building on that, let's look at what happens with those outside investors. If a subsidiary has non-controlling interests that are actually material to the reporting entity, the disclosures get super granular. The parent has to report the subsidiary's name, their principal place of business, the exact proportion of voting rights those outsiders hold, and crucially, the profit or loss allocated to them during the period, plus summarized financial info. The whole point here is ultimate transparency in cash flows. You get to see exactly who is benefiting from the subsidiary's operations. That brings us to Section 4, Joint Arrangements and Associates. If subsidiaries are the direct children, think of these guys as the cousins of the corporate family.
To understand how these cousins are treated, we really have to look at the boundary lines of power.
Having control of a subsidiary means you have absolute power to direct relevant activities and affect returns. It's your show, completely. But with an associate, you only have what's called significant influence. This means you get to participate in financial and operating policy decisions, but you don't control them outright. You basically have a seat at the table, but you're definitely not sitting at the head of it.
Because you don't have that absolute control, evaluating the financial effects of these cousins requires specific, structured disclosures. If the arrangement is material, the entity has to walk through a few steps. They state the name, location, and nature of the relationship. Then, they declare their exact participating share. They have to specify the accounting method used. Is it the equity method or fair value? And finally, they provide summarized financial info like current assets, non-current liabilities, and revenue.
But honestly, this next requirement is where the standard really shows its teeth. Entities must disclose total unrecognized commitments relating to their joint ventures that might result in a future outflow of cash. We're talking about hidden future obligations, like an unconditional agreement to provide a loan, procure equipment, or a commitment to buy out another party's interest if a specific event gets triggered. You simply cannot leave these future liabilities in the dark anymore.
Finally, we reach Section 5, Uncovering Structured Entities. These are the mysterious, distant relatives, and historically they have been the ultimate wild card risks.
First off, what makes a structured entity so unique? Well, it's an entity designed so that voting rights are not the dominant factor in deciding who actually controls it. Instead, the relevant activities are directed purely by contractual arrangements. Think of things like securitization vehicles, asset-backed financings, or entities with a super narrow objective that just don't have enough equity to finance themselves without outside support. They are literally purpose-built machines.
And because these entities are so often kept completely off the consolidated balance sheet, they require intense scrutiny. IFRS 12 doesn't let companies just quietly walk away from them. Even if a company seemingly cut ties and holds absolutely no interest in a structured entity at the reporting date, they still have to disclose their historical sponsorship activities. They must explain how they determined which entities they sponsored, the income generated from them, and the carrying amount of all assets transferred to them. That historical footprint stays totally visible.
This next part brilliantly illustrates the ultimate goal of the standard, which is quantifying off-balance sheet risk. IFRS 12 requires a tabular summary comparing current carrying amounts with the entity's maximum exposure to loss. And maximum exposure to loss means the absolute worst-case scenario. By forcing management to put the recognized assets right next to the absolute worst-case financial risk, you can immediately see the delta. And if a company can't quantify that maximum exposure, the standard forces them to disclose that terrifying fact and explain exactly why.
So what happens if things go completely sideways and a parent decides to voluntarily bail out one of these structured entities, even without a contract forcing them to do it? Well, IFRS 12 demands an explanation. If a parent voluntarily provides financial support, like buying up assets or injecting liquidity, they must disclose the type of support, the amount, and exactly why they did it. This flushes those hidden, non-contractual relationships right out into the open. The days of easily hiding risk in complex corporate family trees are largely over, all thanks to this framework. So I'll leave you with this thought. Next time you look at a company's annual report, try applying this X-ray vision. Dive into the footnotes and ask yourself, what off-balance sheet structured entities is this company secretly supporting? The answers are there, waiting for you to find them. Thank you so much for exploring this explainer with me today.